Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Wednesday morning pre-market webcast. Okay, so we're starting off with a look at the hourly chart because what you had yesterday morning, they tried to take out 71. They couldn't do it. There were some fits and starts off the open. It was a pretty whippy open, to be honest. Then they were able to generate a nice move down. We were able to get into a really nice short. You started to see support come in the 46 area. And then you started to see little chinks in the armor, little buildups here and there. And then, by the time 48, 49 held, they were unable to take out 24.52. So we spent the afternoon basically probing that area. We got long 53 half, we got long 52 half twice. The second one stuck, and we've been running with that one since. So at this point, we've locked in a stop at 60 half, which is below our proprietary moving average and right in the area of VWAP. So it ended up being, after a whippy start, it ended up being a really nice day and a great way to start what is a short week. As we head into today, the bulls have the advantage for a few reasons. They make the higher low. They fail to hold the daily mid-band, which at the time was 24.51. It's still basically in that area today. Then what's more important is after taking out the monthly pivot and weekly pivot, remember they're both locked up there in the 24.58 area. We talked about yesterday, 24.58 being the price of the week. It is the price of the week. If you are above 58, you're in control. If you're below 58, you are in control. They took it out by 12 handles, and they gave all of it back. And not only did they give all of it back, they've given up 5 on the other side of it. That is a very, very important failure. And unless you're going to see the bears come in today and make a rejected lower high that is then going to break this low, the bulls have the advantage into the last 3 days of the week because they have survived the test of daily midband, monthly pivot, and weekly pivot. It's no different than what happened last week when you had that higher low test of the 100-day exponential moving average, which we talked about yesterday. And then you start to see a pop. And the issue becomes the bears keep giving away critical levels. They come back and break them, which tells me, what I've been saying for a while, which is this is a much more two-sided market than what we're used to. This is not just some uptrending ramp job. The bears have their moments, but they still have trouble surviving these violent dip buying rallies. They can't hold them at key areas. And that was what yesterday was all about. The inability to hold 51, the inability to hold 58. So as you get out on a daily, you can see, it's a very whippy day, gigantic range day. And it pretty much closed where it started. You can see we've spent the Globex above both the daily midband as well as the 9-day simple moving average. So what the bulls need to do is take out the Friday high up at 24.79.75. Anything below that, especially if it's below yesterday's high, 71.25, is going to look like yet another lower high. Now, the lower highs don't matter as long as you, as long as you can't get away with holding lower lows. So we've had 2 looks at the 100-day exponential moving average. Back on Wednesday, we had support at the 50-day exponential moving average. Yesterday, we found support at the 50-day exponential moving average. So these moving averages are being consistently won by the bulls. If that continues to happen, then it's inevitable that we go ahead and we make new all-time highs. The bears have put themselves in a corner. They're going to have to fight. As long as we are above daily midband, as long as we're above 58, the advantage will stay with the bulls. All right, everybody have a fantastic day. I will catch you for the midday update. Trade them well. Follow us over on Twitter, Instagram, and Snapchat at Princeton Trader. Check us out on Facebook and join us for a free trial at www.princetontrader.com. Trade 'em well.